What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you as always, I am the bearded boy wonder, Dave Bartosiak, and today, my friends, we're kicking off, well, it's a Tuesday, but still, I'm kicking off another exciting week here of Zach's Live Trader. Have, what is it, like 60% or 70% of stocks is pretty much already reported. But we're getting into the time of the season that I think ends up being more predictable. I like to see some stats, but I feel like later on in the season here, what happens is a lot of the unknowns are gone, and a lot of those event risks that pop up have been dealt with. So you don't have so many reports from the same industry or competitors coming out and one being good and one being bad and whipping the market all around. Now we start to smooth out a little bit. I've noticed over the previous quarters we've been doing this, and that I think it makes for more predictable trading, because what we've done is now we've got our lessons from this quarter that we've learned so far, and one of the lessons is that the head scratching is going to continue. Take Home Depot. Good report, good guidance, and right off the bat in the morning they sold it. Sold it right off the bat, dumped it down. Now, I think the first time I saw this was with Pepsi, and I mean, but what I mean by that is the first time that large cap company, real big company, was reporting. I didn't think they had a terrible report, and early on they start pounding the stock down right away. So what I think that is institutional distribution of shares. So big time funds and investors, mostly funds, right? When you're going to move a lot of stock, you need to have a lot of liquidity in order to do so. So a lot of people have to be trading. A lot of people have to be watching what's happening. And what better time than right after an earnings report in order to do that? So I think that's what we're getting a little bit of here. We were talking about in the chat a little bit that I think it was with David that we might want to fade this thing. Why is Home Depot coming under so much pressure today? You know how these stocks are. I think overall the prospects here on Home Depot are pretty solid, but that is kind of a nasty down day there today, and so it's leaving me with tonight I'm going to do my morning after, not morning after, but rather the Dave's Daily Dive, and I'm going to talk about a lot about what's happening here on the NASDAQ. Coming down underneath the 50-day, gapping up, and then what's happening today. So today looks like we took out yesterday's highs, but hopefully we don't come anywhere near yesterday's lows, and we just kind of have little, not a lot of action here. But I'm concerned that another downward trend line could be developing here, but that's something we're going to look at a little bit later. Now, what does that have to do with Alibaba? Well, not a whole lot. Alibaba is going to do what Alibaba does. And this is one of those stocks that's a little bit disconnected from the rest of the market because it's China, it's tech, it's there's a lot of unknowns to it, and its exotic nature makes for some pretty interesting debate, right? What's up, Bill, PJ, Dean, Dr. Paul, Mr. Tremblay, Mr. Wallace? What are my thoughts on contango? I think you need to be more specific, my friend. Contango where? It takes two to contango. I know that much. I don't know if you're talking about the VIX futures. Perhaps that's what you're talking about. Because I have been talking about UVXY, right? So this was basically the World War III short that I put on live for you guys on Friday. Didn't get the perfect entry, but it didn't matter. This thing was all the way down to 30 today, this morning. Because contango works against this. So one way to, you can see this, let's pull this up. Yeah, VIX pricing. You're always going to have contango. I mean, the norm is going to be contango. Because if you think about it, the VIX is a measure. The VIX. No, you don't get any emails for Dave's Daily Dives, Dr. Paul. It's not that fancy. It's I don't want to like just keep pounding people with emails. Anyway, so let's talk about this real quick. So what is the VIX? It's a measure of the variance of S&P 500 options, right? Index options, a measure of variance. Well, what does that mean? Well, that's the expected range, pretty much, that options are pricing that this thing's going to bounce around in between, right? So it makes sense that the further out you go, the wider out a range would be, right? Further out, you have a greater possibility of returns over a greater period. Now, sometimes the math doesn't always work out that way, and that's when you get oh boy, what happened here? That's when you get backwardation. Oh my goodness, hang on guys, I'm clicking and clacking and breaking everything over here. Can this not happen? Okay. Anyway, sorry guys, I'm trying to get this music back going and I clicked on the wrong thing and now I ruined everything. Okay. So yeah, so naturally you're going to have contango in the VIX futures, okay? There are instances where you don't have that. So the other day, this front, of course I zoomed down on it, reset the zoom. The other day, the front month was higher than the September and then the October, and then it went. So it was like this. It was like a weird curve the other day. And that was because everybody's really worried that World War III was going to pop off immediately. So you got an increased event risk there. And then people are basically saying, well, if World War III doesn't happen here, then it's not going to happen here, right? It's either going to happen now or it's not going to happen at all. So that's kind of why you had that formation in the VIX curve where the contango went to basically nothing. But in terms of VXX pricing, what it's going to do, contango is the reason why that VIX chart looks the way that it does. So there's a reason why UVXY looks like this, right? Do not adjust your screen. 333,000 is the split adjusted cost of UVXY going back to 2013. So that's because that contango is constantly working against it as the UVXY has to move from that front week or front month to that next month, and it happens over and over again, and that's why it constantly works against it. Yeah, Bill, we did okay on that put spread, man. I'm gonna hold it because this thing ain't. This is gonna go under 30, and that's why I went out 2 weeks, just in case the timing wasn't right. Nothing to gloat about yet, man. The trade isn't closed, but so far it looks okay. So I hope it's gonna keep trickling on down, and we should be okay. So that's the thoughts on contango. I know we got a little off track, but might as well talk about it if we're asking about it, right? All right. So let's get back to Alibaba. So the moral of the story here with Alibaba is it's not going to move with the market. It's going to do its own thing. It might move with China. For a while there, it was a China proxy, right? So maybe that's one of the risks. Overall, there's been talk about, trade war with China or something. But Alibaba is not going to be as affected, I don't think, as other stocks would. However, if the market decides to use Alibaba for proxy for China and we get into some kind of trade war, then it could be a problem. But again, guys, I think we're speculating about things that just are not going to come to fruition. There's not going to be World War III. We're not going to have a trade war with China. All these things, right? We just need to reel it in a little bit, I think, overall. Now, Alibaba. What do we do at Alibaba? Um, what's with the recent price action in Alibaba? So, getting a little bit lower. It's come down near, getting closer to this 50-day moving average, right? Makes you wonder. Makes you wonder why, right? Not huge pressure, but it's come down a little bit. I mean, the NASDAQ has come down, but like I said, this thing's got a mind of its own. Maybe we're just, having a tough time justifying the 160s, and we need to have an earnings report to put it over the top. You got the gap up from the previous earnings report. Didn't even got in the gap, just a few bucks, and then found a bid since then. So this is just a stock that's on one of these awesome runs. And it's a head scratcher, right? I almost would rather a stock chop between back and forth in a range than to go from 90 to 160 and then stop, right? Because now you're worried about this potential downside risk, coming off of this earnings report. But we're gonna draw some fibs. We're gonna get into the nitty gritty of the chart a little bit. While I was there, I figured I'd talk about it. Okay, so now let's go over to Alibaba and apply some good old Zaxiness to it. So we've got this price consensus EPS surprise chart. Have a nice little trough here. So again, guys, the black line corresponds to the right y-axis, which is price. The left axis here is EPS. That's going to correspond to these multicolored lines, which represents the evolution of our Zax consensus estimates. Red arrows are earnings misses, green arrows are earnings beats. So it hasn't been all rosy here for Alibaba, coming off a miss, but the market still liked what they had to say after 3 beats in a row. And you can notice here this sort of promises, right? Oh, it's going to be great, and then this growth kind of stalls. Frustrated investors early on, but I think now you're starting to see this EPS really jump up and tug up the stock price along with it. So that's pretty good. So overall, I'd give this this is a good, maybe not great. Oh, it's almost great looking. It's a very good looking price consensus EPS surprise chart, right? The question is just can we keep justifying these prices? Now, we've got it as a Zacks rank number 3 hold right now. They're going to report before the market opens on, I think that's Thursday morning. So you got the rest of the day today and tomorrow to figure out what you want to do. Now look at the revenue growth on Alibaba. 45% year over year revenue growth for the current quarter. Next quarter looks like 45. Current year 46. Next year 33. Was it Amazon in the 20s? I feel like Amazon's in the 20s. And here we're looking at 45s. Solid numbers. And translate that over to EPS. Almost 40% growth this quarter. Next quarter looking to slow a little bit to 22.62. Current year number still looks like 46%. Next year 36%. So there's still a whole lot of positive momentum here. Why is it a 3? Because we haven't seen any earnings estimate revisions. That's why it's not a 3. Okay, or that's why it's a 3. Just nobody has gone out and increased their estimates nor decreased their estimates at all. But we've seen the Zacks consensus go from 66 cents up to 73 cents as older estimates have fallen off. Next quarter has gone from 67 to 77. The current year from 322 to 367. Next year from 416 to 503. Look at that. Just over the course of the last quarter, they had 87 cents to their, or not 87, rather, 87. Yeah, 87 cents to their EPS number. So that's pretty darn solid right there. Even without analysts coming out and increasing their estimates. And you see the disappointment last quarter, but I'm not really all that concerned with that, okay? Let's take a look at the Not consolidated surprise. First, let's look at revenue. Revenue numbers. Let's go a little bit further back. I guess that's right. We can only go a few years on this. So, 27.6% in 2016, 46% in 2017. 2018 numbers look like 47, 74, 2019, 33. So, very good revenue growth numbers there for Alibaba, and that translated over to EPS nicely too. As we can look back, 2016 you actually had contraction in EPS. Distant memory though is 2017 you had 59% growth, and now we're looking 40s pretty much. Almost there. So still very good. Let's look and see what the returns have been surrounding earnings reports. How much of these guys moved? And if you look last quarter, a whole lot of nada. Quarter before, again, not much. Last time we really moved was June of 2016. I remember this because I had FNG, Jeremy Mullen, on the show. We did it in the studio. And we basically went long at the money call and the at the money put. And it ended up working out because the stock really moved. So we got lucky there. And then, again, a whole lot of nada, not much movement. And then 7s and 8s and 9s. But this is when it was just, just being traded publicly. So you expect that. You expect it to whip around a little bit. All right, let's look at the options change, see what we got going on. So again, changes from a stack view to the side-by-side view. They're going to report Thursday morning, so we can look at Friday's call to get a good idea, or Friday's chain to get a good idea what the market is expecting here on this move. $1.55s, that's what we're going to use. Make our calculations. Bust out the handy dandy. 155s are going 5 by 515. Let's call that 508. 155 put, 370 by 380. We're going to call that 375. They're looking for 883 out of this, and the stock's trading at $1.55. So basically 5.7%. So they're not expecting a whole lot. I mean, honestly, that's less than I thought that they'd be expecting. Just about $9. $9 out of Alibaba, which is weird. Okay. Let's look at this now. So we're looking for about $8. So that puts us 148. Awful close to that 50-day moving average, isn't it? Funny how that works. They've been doing this. They've been putting them on the 50-day a lot lately. So just below the 50-day, and then, blow out to new highs, right? We were going to draw some fibs. We're getting in. Yeah, I think really the area. See, you see this 50% fib, just kind of on the 50-day moving average, which is the bottom end of where they're thinking this thing is going to trade. I think that's all kind of solid, okay? And then we've got, upside. Again, these would be kind of targets, kind of targets to the upside, right? Now, one thing to look at, though, is, these sort of lower lows starting to get put in. Are we starting to get into a downward trend channel here on Alibaba? I stopped short of saying that when the thing, sitting here talking about a downward trend channel, and it hasn't been underneath its 50-day moving average since the second trading day of the year. I don't know that you can make a very bearish argument against Alibaba right now, just based on that info. And the CCI is really telling us nothing either, just chopping down a little bit. And I don't even, well, I can put the money flows on here. The problem is this gap up is going to mess with the money flow, but I think that was long enough ago, perhaps. So, you know, just kind of mild, right? Just kind of mild. Very mild here. Okay. So let's stop doing this, hey, in one day kind of thing. Catch you some post-earnings drift, my friends. And why do I say that? Drift. This was sideways. That drifted both ways. A little bit of drift, some sideways, drift. Okay? Let's lean on this a little bit. Get off from side by side. Let's look at the stacked. And again, we're in the September contract. Now, here's the thing, guys. It's going to be a little bit more expensive out here. Now, $8 to the upside, 157. That's 165 is pretty much, right? Because it's almost 157. So if you're looking to get vertical on this thing, you're going to be spending $740 there, getting back $320. So you're going to have $420. Yeah, I know, I had to giggle at that. You're going to have $420 at risk on a call spread here. I don't know that you want to risk that much. I don't know if I want to even be on the debit side of any of these things, guys. So 155 call is 740, right? And like I said, simultaneously selling the 165. You're going to get back 320, but this is still a 420 net outlay. Of course, you can make $10. I mean, sorry, 580 on the 420, so you can make 138% on that. But you know, I like to keep these a little bit lower in terms of what your net outlay has to be, right? But that's if you're going with debit spreads. I think I want to be on the credit spread side, guys, and go a little bit out of the money on each of these. So on the bearish side, getting past these 165s, right? Out past these 165s. And see what this does. So in this case, you're selling a 165 call. You're getting in 320 for that. Okay? But to limit your risk, 197. You're going to buy that 170 call for 197. So here, your net credit is 123. Now the difference in strike prices is $5. Minus that 123 is 377. So in this case, you'd have 377 at risk. You can make 32% on this. And all you need is Alibaba to stay at or below 165 at expiration. So this is a bear credit, folks. So bear credit, which is short, September 15th, 165, 170 call spread for a 123 net credit. Okay. And then on the flip side, if you think Alibaba is going to go up, let's just take the $8 out of that. So it basically puts us 150. It puts us a little below 150 though. But the thing is, do you want to get all the way to 145? And you can. If you want to go to 145, you absolutely can. So I would say that's a little bit more cautious. But let's just do that anyway. So a tad more cautious here. A little bit lower risk, right? Because you're going further out of the money to sell a put spread. You'd sell the 145, you get 233. Simultaneously buying the 140 put, it's going to cost you 137. So $96 is going to be your net credit. Now the amount of money you're going to have at risk here though is going to be 404 because the difference in strike price is $5. Minus that 96 is 404. So here you can make 23.7%, but that should make sense to you guys. You go further away from the money, you're going to get less reward. So in this case, it's only at 23%. Now, what I'm going to tell you guys is if you're cautious enough to go to the 145s and 140, then you should maybe even shorten up your time period too, right? Because otherwise, you're going to have to wait a whole month for 23%. I don't know how many of you guys do that. Stick around that long on something. I think we're trying to find quicker things inside of this for that return, right? So you can always drop the expiration. Now, if you want, I didn't want to do these one-day things, but one-day things can work on a credit, often work on a credit, okay? Now look at this. Now, what was that return? 23% was the return on that 145, right? It's 23%, right? Now look at this. Same price, all the way down at 145. You can sell that for 70 cents. Buy the 144 for 56. That's 14 cents is your net credit. Amount at risk you're going to have is $1 minus the 14, which is 86 cents. So here you can make 16%. So think about that. For a month, you only get another 7%, pretty much. That's how you got to look at it in this regard, okay? But only because you're going so far out do I think it helps offset that risk. Because look at this. We're going to go back to Home Depot. Great report. Everything was good. Now, we didn't do a Home Depot video. But if I could hop in a time machine, I would almost guarantee that the Home Depot, what was it? I bet you it was pricing in a move right about this a little over 3%. I bet it was. So can you imagine having a Home Depot type deal where, the day of, the stock just runs against you and you end up losing money on a trade that you thought was lower risk just because the market got a little, for whatever reason, didn't like some part of the report and logic hasn't stepped in yet. So I'm more comfortable when you guys go out just at least a week when you're using this analysis, right? Now, sometimes we kind of throw caution in the wind. We sort of ignore the Zacks EPS analysis for whatever reason. It's maybe the chart's not quite clear for us, or it's a company that doesn't track well with EPS like an Amazon, right? It's kind of all over the place. Alibaba, I think, has been committed to that EPS, so lean on what you're doing here. You're doing all this EPS analysis, making decisions based on that, so lean on it. Don't make it into a crapshoot, okay? Now, getting back to this front week contract, so you can just go like another week out. Give yourself a little bit of time for some of that to catch, okay? So here we go. So 167s, right? So I said what, 149 to the downside? So here you can do this. 149s. And then you decide what you want to do. You can, the further down you go, the more net credit you're going to get, but also the more money you're going to have at risk. So you got to try and find your little sweet spot, right? I try and make these so that you guys are locked in and it's not, you're not going to lose an arm and a leg if it goes against you. So let's just look at a $2 spread here. So in this case, sell the 149 put. You're going to get 222 in credit. Simultaneously going long the 147 put to limit your downside. It's going to cost you that 169. So here you're going to get a 53-cent net credit. Difference in strike price is $2 minus that 53 cents is $1.47. So here you can make 36% on this trade. It's going to be a week and 2 days after earnings. But if you are in fact bullish on Alibaba and you don't think that it's going to go down more than the options market is thinking, it's a decent way to get 36% there. So I'm going to say our bull credit is short in August 25th, 149, 147 put spread for what was that, 53 cents net credit. See? So there you go. All right. So, what do I think the trade that pays is going to be? Now, here's the real head scratcher about all this, guys. Back to Alibaba, okay? So, we do have positive momentum showing up in our EPS. We've got a stock that's just been chopping around for the last month, basically. From 150s to 160s, kind of chopping within this range, okay? So that's why I'm telling you guys, if you're going to trade anything, don't go with, don't do a debit spread expecting it to break out in one way or the other. I think it's better to go ahead and just fade. Sell something out of the money here. Sell some out of the money up there if you want, okay? We've had a lot. We've put on a few condors over the course of the last couple of weeks. A couple of them worked out. A couple of them didn't really work out, okay? But what I think here on Alibaba, I'm going to allow this price consensus and EPS surprise chart to be kind of my overarching influence. We used it with pretty good success on Coach because we did the bear credit on Coach and that worked out. So I think we're going to do the same thing here in terms of a credit. So I think the trade that pays is going to be the bull credit, guys. I think these lows end up holding. Even if it intraday gets down to the 50-day, I think there's going to be plenty of support there. What's going to be like a fundamental argument against Alibaba that comes out this quarter? Because that's what it's going to take to really pound this thing down. And when you're looking at the revenue growth that these guys have and the EPS growth that they have, I think it's going to differentiate it from what we saw out after the Amazon report. I think it's going to look a little. I think it's going to look a little different. Okay. So, but I'm not going to come out here and be super bullish on this, expecting it to break out to the upside. So really, I think the trade that pays is the bear credit, or the bull credit rather, the bull credit, selling the out of the money put spread, just because I don't think it's going to move all that much. It hasn't moved all that much in previous reports, and I think it's a decent way to pick up a few bucks on a solid stock that has been in an uptrend forever, pretty much. So I think that's what I'm going to go with, guys. In terms of lottos, I think they're too expensive here. Because if you look at this, even going out one day, you're going to pay a lot of money. You know, you got to pay 46 cents for the 140s. You got to pay 85 cents for the 146. So I don't know if I'd mess around with that, guys. Did anybody put on the Coach lotto? That's what I want to hear. Tell me somebody did. I think it was the 43.50, like the 43.50 put on that. Anyway, so trade that pays is the bull credit. Okay, lotto's very expensive. So there you go, guys. And PJ, if it is priced in, that's all the more reason to sell out of the money put spreads or out of the money call spreads. It's all the more reason why it shouldn't move around a bunch. No, it was the 44.50s, Dr. Paul? Wow. All right. So that's what I'm looking at, guys. That's all I got. Thursday morning they're going to report. So Friday, we'll see how they act. We'll talk about it in the morning after on Friday, though. But I think John Deere reports Friday morning. So I think that'll be the more immediate focus of what we got going on Friday. We'll look back at what a couple of these other trades look like. We will talk about the UVXY. The other ones I've been talking about in the chat are the USO short and the FXY short. Okay, so basically Dave's looking for dollar strength. Yeah, Bill, that's a good point. AOI pre-announced and they still moved 30%. So there you go, guys. What do we got tomorrow? What's today? Tomorrow's deer. Tomorrow we're going to do deer. Thursday we're going to do Momo. That's actually, I'm excited about the Momo thing on Thursday because I've got them in home run. So it should be good. And then Thursday, obviously, we're going to have the good, the bad, the ugly trade review. And then Friday, the morning after, guys, come on down for the morning after because I think we had fun last time, especially with having bowling on there. I'll see if I can trick other people into coming on, but we'll try to find some good, man, and just keep on rocking out. So I'll see you guys in the chat a little bit later on. And that's about all I got for you guys here today. So thanks for hanging out with me here on Zach's Live Trader, and I'll see you all very soon. Have a good one.